Paul Kitney is chief equity strategist who now joins in on the phone line. Paul, what a disastrous last week it's been, and equity investors have certainly borne the brunt of that massive global sell-off. Question is, after seeing a disastrous week, is there still room for more downside?
Good morning. Yes, I think really the external spread of the coronavirus away from China. In fact, new cases outside of China are now greater than those in China. In fact, mainland China cases are actually new cases are actually starting to drop. We've certainly seen, a very sort of risk-off type environment, and I think what people's concerns is that the disruption to supply chains that was present due to the ongoing trade war are only going to be further compounded by another supply chain shock coming through the coronavirus. Now, to the previous contributor's point, this is sort of less of an issue to domestic demand-driven markets such as India and domestic sectors within India and other parts of the emerging market space, perhaps like Brazil, and so on. In contrast with those heavily trade-oriented markets such as Germany, Japan, South Korea.
Paul, we were discussing a while ago that should one buy the fear, or should one understand that this is just the beginning of a long winter? What is your sense?
So what we've done last Friday was actually we took a very contrarian call into the very weak record low Chinese PMI data and upgraded China and Hong Kong. So we upgraded China and Hong Kong from underweight to neutral and China A to overweight, taking the view that this particular shock to manufacturing is going to lead to quite a significant coordinated global monetary and fiscal policy intervention. So we expect to see rate cuts in China, more fiscal stimulus in China, particularly after the next NPC meeting, which should be coming up in the next few months. It's been put off from March to an uncertain date as yet. And we see that the effect of the coronavirus on the oil market, driving oil prices down, is shifting down inflation expectations, which the Fed cares about tremendously. So the Fed's policy reaction function cares about inflation expectations, and we see the Fed coming back and cutting rates much sooner than they had previously advised, in which case for us, at this particular point in time, we did not want to actually be too short, in particular not short in the epicenter of this crisis in Hong Kong, China, and made some adjustments there.
Appreciate your time. Thank you for joining us. So, I think we come back to that same point that, look, globally, the governments will come together, and I think they will do whatever it takes in order to contain coronavirus. And you think about it, from China, the news appears that things are peaking out. Now imagine you wake up in the morning, and even from US, the bad news has not been very steady. From Italy also, the cases have not really exploded. France, 1 or 2 cases, but no explosion has happened in Europe. So all I'm saying is that if markets get a sense that coronavirus is getting contained, then perhaps the narrative changes. What you need to figure out is that because of coronavirus, growth will slow down.